everyone, Leticia here, coming to you for another edition of my weekly Money Matters webinars. And again, I'm sorry I wasn't able to do my webinar last week. My Wi-Fi situation was very unstable. I am at a stable Wi-Fi place right now. And today we're going to be discussing the topic of investment loans. Many people want to get started with investing, and many people have already done some investing. However, unless you're already maxing out your RSPs and TFSAs, and what I'd like to say is most people are not yet maximizing what they could do in terms of their investments. And you may or may not be aware that there are programs out there that would actually lend Canadians money. I cannot speak to the US or other jurisdiction, but I can speak to Ontario and Canada. We have institutions that are there to provide investment loan programs to help Canadians catch up on their investments. And I'm just going to let you know for today's presentation, guys, I'm going to be using some visual aids, but it's not going to be a formal PowerPoint. Unfortunately, I didn't have a chance to prepare that. I do apologize. But this is a topic that I've been wanting to share with you guys about, just so you know what you have access to. And the reason this came up is actually one of my contacts is looking to take advantage of some investment opportunities, and he reached out to me. Now, unfortunately, he had already borrowed from other sources that were actually more expensive, and he was a little bit over leveraged, so we were not actually able to take advantage of these programs at this point in time. But I want to let you know that these programs exist, and I want to let you know a little bit about them, so that you're aware, and that if you're in a situation where you want to take advantage of something like this, at least you know what's out there in the marketplace. And so we'll talk about, there's actually a little introductory video. Now, in terms of the providers of these types of loans, there are only, now all the major banks will offer these sort of loans. However, speaking to one of my contacts from who had worked at Scotiabank for something like 19 years, one of the things she told me was that the loans were collateralized. So meaning, let's say you borrow money because you want to catch up on your RSP contributions. The money, if you're with Scotiabank, at least this is what she told me, was that if you later decide to pull the money out from your RSP for whatever other reason, you wouldn't be able to, as long as there's still a loan outstanding. With the loan programs I have access to, that doesn't apply, doesn't necessarily apply, and I'll explain to you how that works. Okay, so I have a 2-minute video I'd like to share with you. Let's see, I'm actually using a Mac at the moment, long story. So I will see if it will work out okay in terms of sharing the screen. Give me 1 second, guys. Okay, so this is a little 2-minute video.
15 years to grow your savings to approximately 10,000.
No, we're gonna try to go back to the beginning. Yeah, I haven't used the Mac in a little while, so bear with me. Okay, all right. No, how do I go back to Zoom? Oh man, okay. Share screen, okay. All right, hope you guys can see that. Okay. Okay, there you go. So this is a presentation from one of the leading providers of investment loans, and they're called B2B
Looking
Bank.
to get a head start on your investment goals? Or maybe you need to make up for lost time. With the help of your advisor and B2B Bank, there are ways to accelerate your savings right now. For some, an investment loan can be a great way to fast forward your savings through an initial lump sum contribution.
Can you guys let me know if you can hear the sound, by the way? Can you, are you able to hear my sound from my screen? I'm gonna look in Facebook right now and find out. Sorry about that. I just wanna know because sometimes the sharing of the sound doesn't work. Okay, oh man, I'm just so not familiar with this laptop. Okay. Okay, I'm sharing the wrong screen right now. Okay. I will go back to the screen I was sharing, and let's hope you guys can hear it.
Contribution. How does it work? Most people build their investment by making regular contributions over a period of time. Each year you contribute, your total investment amount grows. However, each subsequent year, the amount you contribute has less time to grow, creating a lost opportunity for returns. But with an investment loan, you can benefit by borrowing an initial lump sum of money up front to invest. Any potential returns are compounded immediately, meaning that returns are calculated not only on the initial investment, but also on the accumulated growth from year to year. Additionally, interest paid to borrow money to earn investment income is generally tax deductible. Let's review each approach. Say you have $400 to invest each year for 20 years. With a typical savings plan at a 7% annual rate of return, it would take 15 years to grow your savings to approximately $10,000. After 20 years, your investment would be worth $17,546. However, if you took the same $400 and used that for interest-only annual payments on a $10,000 investment loan, the entire loan amount could benefit by being fully invested for all 20 years. Your investment would grow to $38,696, and even after repaying the $10,000 loan principal, you would have $28,696. That's $11,150 more than the typical savings approach. While investment loans have the ability to accelerate gains, they also have the potential to magnify market losses, depending on how the investment performs. When used properly, an investment loan can be a powerful wealth-building tool, but may not be suitable for everyone. If you think borrowing to invest is a strategy that could be right for you, speak with your financial advisor today. To learn more about B2B Bank investment loans, visit b2bbank.com/borrow to invest.
Okay, I'm gonna stop sharing the screen now. How do I do this? And then okay, maximize. There's my Zoom. That's not where it is. Okay. Oh, okay. Okay. All right. So hopefully that provided a quick introduction to the concept of borrowing to invest. And I'm glad the video mentions at the end that there is some risk involved with this concept. So those of you who are real estate investors are well familiar with the concept of borrowing to invest, because in real estate investing, you use some of your own money as a down payment, and then a bank or another type of lender lends you money so that you can purchase the properties that you want. People are less familiar with the concept of investment loans when it comes to other types of investments, or perceive it to be very risky. And indeed, there is risk applicable. So for example, in this video, they were showing a 7% annual average compound rate of return. Is that achievable for most people? Well, potentially, but we all know that to achieve that kind of interest rate, you're going to need to have some equity exposure. You're not going to achieve 7% rate of return investing in GICs, which are also known as guaranteed investment certificates. They don't even beat inflation. So you obviously, the idea here is you want to be in a type of investment that is likely to return more than the interest rate that you're going to be paying on the loan. Now, the good news is these interest rates, especially in the kind of low interest rate environment we find ourselves in currently, interest rates have never been as low as I've seen them, including for these types of loans. And so I'm going to share with you some features of the loans, as well as in case you're wondering, if you were to apply for this type of loan, what kind of credit score you might need to have, or what kind of things would the lender be looking at. So first of all, let's talk about the types of loans that are available. And I'm going to primarily talk about B2B Bank. B2B Bank, they are a subsidiary of Laurentian Bank of Canada. I can't tell you how long Laurentian Bank has been around, but ever since I've been in the industry over 10 years, B2B Bank has been a provider of investment loans. So that's what they're known for. They offer mortgages as well. I'm not a mortgage broker. I don't think mortgages are their bread and butter. investment loans are their bread and butter. And I'm actually going to show you their website, and I'm going to show you some of the plans they have, some of the programs they have available, and I'm going to share their website with you as well. And I'm also going to show you some of the interest rates you can expect to pay for these loans. One of the things I like about their loans is that they are open loans. So if you choose, depending on the length of term that you choose, if you come into some money and you're wanting to pay off the loan sooner, there's no penalty for that. Okay. Not only that, but they allow even up to a 10-year loan period. So what I like about that, now some of the reason let's talk about why would anybody want to use an investment loan. One of the reasons was, okay, well, I need to catch up on my investments, and with every year that goes by with me not making a contribution, that's a year of compound interest lost, whatever type of investment you may be in. Okay. Whereas by depositing a lump sum now, right off the bat, this money starts accumulating interest and growing at whatever rate of return your investment may be giving you. Okay. Now keep in mind, typically from day one, now you have the option of deferring that initial loan payback payment as much as 6 months with B2B, and there's one other provider, BMO, is also in this business. Now again, so we spoke about the level A banks offering these types of programs. Now the problem with those guys is that, number one, they're going to expect you to invest in one of the investments they have available. It's typically going to be mutual funds, and it's going to be at and according to my contact who worked at Scotiabank for 19 years, they collateralize the loan. So if you decide to pull the money out, they won't allow you to pull the money out until the loan is paid back. The loan programs that B2B makes available, including to independent advisors like myself, we're essentially independent insurance brokers, financial advisors. We have access to many types of investments through, in my case, through the insurance companies I represent. So what would happen is B2B has partnerships with all these various financial institutions. So once a client applies for the loan and qualifies for the loan proceeds get deposited in, let's say, your RRSP, in this case, it could be at Industrial Alliance, it could be at Canada Life, it could be at Empire Life, one of the companies that I work with. Now, the investment programs that I have access to, again, we spoke in the past about segregated funds. They're very similar to mutual funds. They offer some additional benefits, and we discussed those on another call. Now, if you wanted to now take that money to a different institution, you could do that. So you're not necessarily stuck to any particular, they don't collateralize the loan, unlike a bank-like lender, okay? Or if you wanted to even do a direct withdrawal for whatever reason and use that money for other purposes. Now, keep in mind some of the benefits that the video talked about. I don't know if it got into the fact that interest on an investment loan is tax deductible. Those of you who are real estate investors know that you can deduct the interest on a rental property mortgage. So as long as you are using the loan proceeds for an investment, you're allowed to, you are granted interest deductibility. Anyway, without further ado, let me show you B2B's website and show you some of their loan programs and some of the interest rates that you could be looking at, okay? And by the way, if you have any questions, feel free to put them in the comment section. I'll be happy to address them, okay? At the end of the video, okay? So. Okay. Okay, I'm going to share my screen with you again. Share. Okay. Well, so there you have it. Laurentian Bank has been in business for 175 years. So they've been around for just about as long as some of the other banks in Canada, not surprising. And here we can see some of the loan programs that they offer. So in Canada, as you know, you have an option as an investor to invest either in what's called a registered plan, such as an RRSP or a TFSA, or in a non-registered investment, which is not, so the benefits of registered plans, as you know, you get certain tax benefits with the TFSAs. It's tax deferral, so any growth that takes place in your TFSA would not be taxed by the government. Same thing with the RSP, as long as the funds remain in the RSP. With the RSP, in addition to that, as you know, when you make a contribution, that amount gets deducted off your taxable income. Perhaps we could do another session on this in the future, but the idea is, and yeah, so TFSAs and RSPs, there are certain legal limits that the CRA sets out as to how much you can contribute every year. So with RSPs, it's about 18% of your gross income every year. With TFSAs, I think it's back down to $5,000 per year for a while. And I believe it's becoming adjustable by inflation. I'll have to double check this because they keep changing this, okay? But bottom line, even if, so let's say you're a client who you haven't yet contributed to an RSP or the TFSA, or not as much as you may have liked. As you know, when you file your taxes every year, the CRA sends you on that notice of assessment, they send you what your RSP maximum contribution is, or your contribution limit, and your TFSA contribution limit. And so the CRA keeps track of those things, whether or not you've made a contribution before. Which means that as a client, if you wanted to top up your RSP or TFSA up to the extent of your contribution limit, you could certainly do that. Okay. Now, again, you may not be in a position to do that from your own resources. This is where loan programs like this can come into play. Okay. And so once again, let's have a quick look. Let's have a look at their TFSA program, for example. As you can see, they have a minimum investment, a minimum loan amount of $5,000. You can have up to 10 years to pay off the loan. Okay. The nice thing is right now, at this point in time, well, actually, B2B was a leader in this, and they've been a leader. They created an e-app, an electronic application, as far back as a few years ago. So they, it's a fully online process. It's become very easy to use these days. Okay, so TFSA loan minimum of 5,000. The maximum is the maximum contribution limit allowed, which last year was about $64,000, which was the cumulative limit if you've lived in Canada, if you're a Canadian resident who's lived in Canada since 2009 and beyond. Okay, with the RSP loan, not much different. Well, I believe, yeah, so this is one of their most popular programs. They, the TFSA loan, they only introduced that a couple of years ago, but the RSP loan is something B2B has offered for a long time. As you can see, you can choose to have as low as a $2,500 loan amount. Clients of mine usually go for higher than that, but it really depends on the client's profile, you know, and what they're hoping to do. One of the most popular reasons people were accessing, especially the RSP loan, is because, as you may know, in Canada, we have something known as the first-time homebuyers plan. So with a first-time homebuyers plan, you are allowed to, used to be that you could pull out up to $25,000 from your RSP. Now that's been raised to $35,000 that you can pull out from your own RSP to put down as a deposit on your first home. Now, let's say you have some savings in your RSP, but not $35,000. You could choose to top up the amount that you have in your RSP using a B2B loan, for example. And then the rule is that the funds have to season for 90 days. So the funds would have to be in your RSP for 90 days, after which you could pull out the entire amount and use it as a down payment on your first home. This has been one of the most popular uses of these types of loans. And it's one of the features that, one of the benefits of the RSP. Now, you could choose to pull money out of your RSP sooner, but the issue will be that you will be, there are penalties that get charged, and those penalties are essentially an estimation of the amount of tax savings that you benefited from by making the RSP contribution in the first place. So if you're looking for flexibility to be able to pull money out, move money to a different type of account, the RSP loan would not be ideal. Ideally, you want to be looking for a TFSA loan or potentially a non-registered loan. Now, I should make the point that both TFSA and RSP loans are 100% loans. So you don't have to, as a client, come with any down payment. It's really like a 100% loan to value. Now, there are certain credit worthiness criteria that B2B looks for, and actually, let's see if this video goes into that. Let me see if I can. Sorry, let me see if I can share this screen again. Okay, yeah, it's there. Let's see. It's going to talk about some of the.
As an advisor, you can evaluate your client's ability to qualify
This is for
an
advisors.
RSP loan before submitting an application to B2B Bank.
But you guys can
use
also
B2B Bank's
understand.
RSP Credit Basics to help you pre-screen your clients
That's
and
right,
improve
okay.
the experience for you both. Capacity. How much debt can your client reasonably carry? Capacity is also known as Total Debt Service Ratio, TDSR, the amount of additional debt a person can reasonably afford to carry. How is it calculated? Take your client's total monthly debts, such as mortgage, loan, and line of credit payments, and divide by their gross monthly income. You then times this number by 100% to get their TDSR. A good rule of thumb, TDSR should not exceed 40%. Capital. Is your client able to repay the debt? Capital is the measure of your client's net worth. It shows their ability to manage their finances and accumulate assets while repaying their debt obligations. How is it calculated? Subtract the total amount of your client's liabilities from their total assets. The result is their net worth. A good rule of thumb, net worth should be at least the same as the loan amount. Credit history. How has your client handled debt obligations in the past? Credit history is a collection of information about a client's past behavior in meeting debt obligations. Lenders use a credit scoring system to determine the credit risk and the credit worthiness of a potential borrower. Scores go up when loan payments are made on time, credit card debt is paid down, and no bankruptcies, collections, or judgments are against an individual. A good rule of thumb, the higher the credit score number, the better. Character. Does your client have good financial habits? The character of an applicant is based on a number of factors. How do you determine the character of your client? Ask questions such as, how stable is their career? Do they pay their bills on time? How long have they lived at their residence? Are they upfront and willing to provide complete and accurate information to you? B2B Bank's RSP Credit Basics can help you assess the likelihood of your client qualifying for a loan, so that when you recommend credit products to them, you can do so with confidence.
Okay, so even though that's a video for advisors, at least it also helps you as a potential client understand sort of what the bank looks for. And one of the things you probably you're curious about is like, well, you know, is there any point in me applying? Number one, you saw obviously they talk about credit score, and just so you know, usually they're gonna need a minimum 640 credit score. So if the credit score is lower than that, it will result in an automatic decline. So we wouldn't even bother contributing. Another thing I've noticed is if a client is maxed out on their credit cards, again, that's not gonna help. So your credit score may be decent, but if you're somehow maxed out on credit cards, that's also going to lead to an automatic decline. So what they also want to see is about a 60%, 65% utilization on credit cards. That generally helps. What else? Net worth. Again, unfortunately, I've had some surprises in this area. So pretty much what they say there. If you're applying, let's say you're applying for a $10,000 loan, ideally, you want to have at least that much in net worth. Now, it doesn't have to be liquid net worth. It doesn't have to be money in the bank. It could be part of your overall net worth. Let's say home equity could form part of that. But again, and that's kind of surprising though, because definitely I was told definitely for the TFSA loans, which give you the highest level of flexibility, because with the TFSA, there are no penalties. Like, let's say literally you could have the money deposited today, and you could come tomorrow, you can go to your institution tomorrow and say, well, I want to withdraw my funds and invest in something else. Okay. I don't want to give you any suggestions, but there are alternative investments out there. And so B2B, it has affiliations with some of the traditional financial institutions, whether it's mutual fund dealers or the insurance companies that provide segregated funds or mutual funds. Some insurance companies, well, they have a separate investment division and so on. But so with B2B and most of these companies, yeah, you're going to want to have at least as much as a net worth as you are, as the loan amount you're applying for. How quickly can you expect to get funded? As quickly as 48 hours, we usually know. And within 5 days with the paperwork, within 5 days, you should have the funds. I don't know if there are any questions, guys. I'm going to have a look at the chat. I think I've gone on talking for long enough. Let's have a quick look here. Okay, no, I'm not seeing any questions as of yet. Okay. Trying to think if there's anything else I should cover. Yeah, you know what? I'm going to show you a little bit about oh yeah, I was going to show you what kind of interest rates you can expect. So again, we spoke about how there is an inherent risk with investment loans. So if you're going to be borrowing money to invest, you want to make sure, you want to do your best to ensure that whatever other type of investment you're putting your money, whatever investment you're putting your money in, you're going to be earning a higher rate of return than what you're paying in terms of the loan, because regardless of what your investment does, you're still going to be on the hook for the loan, and your credit could potentially be affected if you don't pay the loan. So it is a loan. It's a financial responsibility that would show on your credit score, on your credit report. Okay. Let me show you what kind of rates they currently have available. Let me see. There's on their website, there is a section where they talk about the rates. There you go. Loan rates. And I'm going to share my screen with you. Okay. Let's have a quick look. Okay. Oh man, don't tell me. Okay, there it is. Okay, so the investment loan program, and they call it, okay, and I'll tell you how that works. So so the RRSP loans and the TFSA loans are 100% loans. So as you can see, they have the current loan rates. They depend on the, okay, they depend on the length of the loan. So for example, as you can see, for an RSP loan, depending on if your term is 2 years, you're going to get the best rate, 2.95% currently, plus 50 basis points. They also, that's the variable rate. That's what most people go for. On the RSP side, they also offer these fixed rates. As you can see, they're not as advantageous. Okay, so most people go with a variable rate, especially in these low interest rate times that we're in. Okay, and as you can see, 3 to 5 years. So the longer loan period you choose, the higher the interest rate would be. Now, the TFSA loan rates are particularly good, as you can see. So actually, I apologize. So this is actually the total rate up on the top. So if it says 2.95, that's all you're looking at. 3 to 5 years is 4.75. 6 to 5 years, 5.40. as you can see, and that's for the RSP. For the TFSA, rates are even better. So even on a 10-year loan, you're looking at currently only 3.95%. This compares favorably to most unsecured credit, unsecured lines of credit from a bank, okay? Or it's at least as good as an unsecured line of credit. And it's certainly much better than a credit card interest rate. Okay, so again, some people right now are looking to take advantage of some investment opportunities in what I like to call alternative investments, whether we're talking about we had people talking about private lending or investing in REITs or even things like cryptocurrencies. Again, while B2B does not have a direct relationship with these alternative investment providers, you could, well, to the extent that you qualify for a loan and you get these funds deposited into a more traditional TFSA or RSP, but again, the TFSA would be the most flexible option. You have the option of then taking that money and investing it in something else more to your liking. In case you're wondering, I don't get paid by B2B, so how myself as a facilitator of the loan makes money is we charge a small percentage up front. That's something to be negotiated, just something to take care of my time for going through the paperwork and setting up the loan for you, okay? And now, obviously, if you were to remain in one of the investments I provide, there's no need for me to charge anything up front. But if your intention is to then, let's say, take the money and invest in something else, there has to be some compensation for my time because there wouldn't be any trailers or anything for me as an advisor to make any money on, okay? And obviously, this is, something I have access to as an advisor, investment loans. Now, one type of loan we haven't spoken of are they actually have leverage loans. So like in the example of a mortgage where you as an investor may put 20% down and then the bank would lend you the remaining 80%. It's not as generous when it comes to other investment loans. So for example, for the RSP and DFSA loans, these are 100% loans. So you don't actually, you as a client would qualify strictly based on your credit worthiness and the other factors that were discussed in that brief video. So literally your credit profile, your credit worthiness, they don't need you to show any down payment or that you have equity of your own in that particular investment. If you're going to be asking for a loan for a non-registered investment, so some people are in a position where maybe they've already topped up their RSPs, or maybe they're a business owner and topping up their RSPs and being investing in RSP is maybe not in their best interest for whatever reason, or they don't like RSPs, they think they're too restrictive or what have you. Maybe you prefer to be in a non-registered investment. The TFSA, I would say, is good for most people, but as you can see, B2B also offers these loan programs 3-to-1, 2-to-1, or 1-to-1. Yeah. So in other words, 3-to-1 loan means that you would have to show, in the case, let's say you're, oh man, I should be better with numbers. But in other words, you put one part, B2B would put 3 parts. You put one part, B2B would put 2 parts. And again, I think what they're looking at is credit worthiness in terms of what amount of leverage they would be willing to advance. And in their case, as long as you're invested for this type of loan, you would have to remain invested with whatever provider is offering the investment. So whether it's a bank or an insurance company, you would have to remain in that investment. So they're less flexible than something like a TFSA loan. Okay, a TFSA loan, literally, like again, those of you who are real estate investors, for example, and you needed extra funds for renovation of some kind or what have you, you really, this is potentially an unexpected source of funds for those of you who are active investors, and maybe you haven't bothered starting up with the FSA because you don't think the interest rate, the returns are worth it because you've got something else going on. Maybe you're an active real estate investor and you're getting superior returns doing that. But you as a Canadian have the right to contribute to a TFSA. So, and again, the nice thing is there's no obligation to keep the funds in there. So once the TFSA is funded, obviously you're still going to have to service the loan, make the monthly interest payments, and pay down payments, but at least you have the flexibility to take that money now and invest it elsewhere, okay, whether it's real estate and other things, more exotic things, okay. I think that's pretty much all I wanted to cover for today, guys. I'm going to see again if there are any questions. Okay, give me 1 second. Back to Facebook. Okay, I don't see any comments or questions yet. Feel free to put them in later. And yeah, one last thing I want to mention, if you're wondering whether something like this would be appropriate for you, let me stop sharing because I'm sharing myself. Yeah, if you're wondering whether something like this would even be appropriate for you or could be a good solution for what you have in mind, there are a couple of pre-screening questionnaires that we could go through together on the B2B website. Number one, to determine what they call in that little video, your total debt service ratio. So again, usually they want to see it below 40%. We're not going to be doing any credit check. The only time the credit check happens is at the time of application. If you're uncertain about your credit score, it's usually a good idea to run your own report. You could go to Equifax. I could show you how that's done. But in case you're wondering about where your credit score is at before you actually go ahead and submit an application, because we would want to have a surprise at the last minute. And I've been surprised sometimes with my credit file. I remember one time, the first time I ever pulled my credit, when somebody told me, oh, this is how you do it. Maybe we should do a session about that. But it turns out that there was an institution in my credit report that I had never had any dealings with, and they were showing us having a loan with me, and I never had any dealings with that institution. So thankfully, I was able to reach out to Equifax. I don't remember if I had to go in person or I think I simply sent an email. I don't remember how I did it, but there's a way you can correct errors in your credit file. So it's always good practice to check your credit file every so often, just to make sure there's nothing weird going on. Because again, obviously there was some human error involved, and I was surprised, and to think that a lender that I had no relationship with, I had no idea who these people were, was actually affecting my credit worthiness in front of any potential lender. And who knows for how long that had been there. Now, this was many years back. Since then, I've learned, and I do check my credit on a regular basis. I would say at least every 3 months. I know there are programs that allow you to check it every month and you pay a monthly fee. I mean, personally, I think that's excessive, but to each their own. I would say at least once a quarter, you want to kind of know where you're at. So that's about it, guys. Thanks for watching and listening. Again, I apologize this hasn't been as polished as I might have liked, but I didn't want to skip another week. It's been a little crazy. My laptop is actually dead at the moment. Looks like I may need a new motherboard. Yeah, not what I was looking for. So